Hello, my name is Chandra Gale, and this is Group 9 presenting our analysis of the findings from S6 Annual Surveillance Report 774. Our presentation is divided into three parts. I will be discussing on the audit evidence, while two of my friends will be deliberating on audit veracity and audit advices. To begin with, what is audit evidence? According to the audit standard ASA 500, audit evidence means information used by the auditors in arriving at the conclusion on which the auditor's opinion is based. Audit evidence are important because it forms the basis upon which auditors express their opinions on financial statements. Through audit evidence, auditors can validate management assertions and ensure that a company's financial information is accurate and reliable. It reduces the risk of material misstatement, and a well supported audit opinion increases the credibility of financial statements. The ASA 500 requires that the auditor obtained sufficient and appropriate audit evidence to draw reasonable conclusion on which to base audit opinion. What does the case study material tells us about audit evidence? S6's primary concern was that the auditors did not obtain sufficient and appropriate audit evidence, and therefore they did not have a sufficient basis to support their opinion on the financial reports. Under all key audit areas, S6 detected that auditors did not obtain sufficient evidence to support their assertions. So the lack of sufficient audit evidence was largely found under impairment of non-financial assets and asset valuation, particularly the goodwills, and other significant area was under the revenues and receivables. Our findings from significant audit area indicates that auditors did not obtain sufficient evidence for impairment testing or evidence to support the reasonableness of key assumptions. Auditors accepted valuation methodologies that may not have been appropriate or reliable, resulting in materially misstated goodwill at year end. The auditor did not adequately challenge the entity's conclusion that there were no impairment indicators. On the revenue and receivable side, auditors failed to obtain sufficient evidence of the occurrence of the revenue. Our analysis based on literature provides that, given the subjectivity and complexity of the assumptions involved in impairment, especially the goodwill impairment, auditors may find it challenging to sufficiently test or challenge the management's projections, especially when the market data or independent evidence to support this assumption is limited. ANS et al. Findings suggest that factors such as profitability, corporate governance, company size, and regulatory environment significantly influence the auditor's approach to testing assumptions in goodwill impairment assessment. Our auditors often face challenges in rigorously testing cash flow models and may accept the entity's valuation methods due to perceived low risk, high complexity, or reliance on the governance structures. Findings from revenue indicate auditors might have placed excessive reliance on the client's internal controls and management. Auditors often face pressure to complete audits within tight deadlines or budget constraints, leading to shortcuts in procedures, including reduced sample size or limited testing of certain transactions. Auditors may not have exercised sufficient professional skepticism, especially in areas they perceive as low risk, resulting in a less thorough investigation of evidence supporting the occurrence of transactions. The report's analysis regarding the sufficiency and appropriateness of audit evidence indicates that auditors often did not obtain a reasonable assurance that the financial reports were free of material misstatement. Major findings concerning evidence under key audit areas were those that needed professional judgment and subjectivity. This can be linked to auditors' non-compliance with auditing standards, which has resulted in insufficient evidence to support their opinion on the financial reports, thereby impacting the accuracy and reliability of the reports. Alternatively, ASIC's findings can be viewed as an issue of a deficient performance gap, in which ASIC is relatively unsatisfied with audit firms. Unreasonable expectations have been a persistent issue for auditors as they determine the value of auditing and the reputation of auditors in modern society. So, acquiring high quality evidence is always challenging and necessitates a cost benefit analysis. In reality, auditors form an opinion based on the available evidence, risk assessment, and professional judgment, which may also allow for alternative viewpoints.
Hello, I'm Dichen, and I'll be addressing the impact of a case study with the respect to the veracity of audit practice. Veracity in audit practice emphasizes on truthfulness, accuracy, and reliability. It also emphasizes on the importance in maintaining trust in financial reporting. The 5 key elements comprising of veracity in audit practices are auditor independence, objectivity, adherence to professional standards, thorough evidence gathering and evaluation, effective communication of findings, and commitment to continuous improvement. The case study, as discussed in the ASIC Audit Inspection Report, underscores critical deficiencies in audit practices, which have significant implication for the veracity of audit practices. The veracity in audit practices revolves around adherence to truthfulness, accuracy, and reliability. When our audit process fails to meet this criteria, it can lead to misleading financial statements and undermine stakeholders' confidence. Here's a detailed analysis of the impact with the respect of veracity. As addressed by my friend earlier, here the auditors fail to adequately test and challenge management's assumptions, such as discount rates and cash flow forecasts, leading to potentially inaccurate asset valuation. This lack of rigor can result in the overstatement or understatement of asset values, which compromises the reliability of financial statements and misleads stakeholders about the company's financial health. The failure to perform robust sensitivity analysis and validate fair value models increases the likelihood of material misstatements, especially in uncertain market conditions, diminishes the trustworthiness of financial reports, reflecting poorly on the audit's integrity and reliability. The Valiant Pharmaceuticals case illustrates how inadequate sensitivity testing and impairment analysis can lead to significant stock price declines, regulatory investigation, and financial restatements. Auditors inadequately tested internal controls, particularly in expense capitalization and asset existence, which allowed errors and misstatements to go undetected. Weak internal control testing can lead to material inaccuracies in financial reporting. The WorldCom scandal highlighted the devastating consequences of such failures, leading to one of the largest accounting frauds in history and resulting in the Sarbanes-Oxley Act of 2002, which mandates stricter internal control requirements. Inadequate document of independent assessments and breaches of auditor rotation requirements suggest compromised independence. Compromised independence undermines the audit process integrity and can result in inaccurate financial statement that can mislead the stakeholders. Insufficient development and monitoring of action plans by firms to address negative findings. Without effective action plans, deficiencies in audit quality persist, leading to repeated mistakes and weakening stakeholder confidence in the audit process. Inadequate testing and assessment of revenue recognition policies and estimates can lead to significant misstatements. Misstated revenues, as seen in the Tesco accounting scandal, can mislead the market and affect earnings, underscoring the need of rigorous audit procedures. The last finding was provisions and the contingent liabilities. Auditors here did not adequately test provisions or the appropriateness of contingent liabilities. Such inaccurate testing can result in financial reports that do not accurately reflect a company's obligation, misleading the stakeholders. The findings from ASIC Audit Inspection Report reveal several critical weaknesses in audit practices that directly impact the veracity of financial reporting. These deficiencies led to the material misstatements and undermined public trust in the audit process and the financial information presented by the companies. For audit firms, addressing this issue is crucial to enhancing the quality and reliability of their audits, ensuring that financial statements provide a true and fair view of a company's financial position.
Hello, I am Dishnu. So I will be addressing question number 4 and question number 5. Firstly, the question number 4, that is about the advice to be given to audit information users based on these findings. Audit reports are essential tools relied upon by audit information users or stakeholders in making any economic and financial decisions, according to Goykosia et al. 2021. When using audit information, it is crucial for users to manage their expectations and understand the audit process. So it is also important to differentiate between the responsibilities of auditors who provide opinions on the financial statements and the management who prepare them. Now, based on the findings of the ASIC reports and the expectations gap observed, here's the advice to audit information users. Firstly, the understanding the scope. Audit reports do not offer complete certainty, which is a common misconception. So auditors are not required to detect all frauds or errors, but to provide an opinion on the fairness of financial reports. Users should understand that audits offer reasonable, not absolute, assurance and adjust their expectations to recognize the inherent limitations of the audit process. Number 2 is examine on high-risk areas. Under this, asset impairment and revenue recognition have been highlighted as two major areas where audit quality has gaps. So users should critically assess these areas in financial reports and not rely solely on audit opinions. However, users must also take initiative by actively seeking information and paying close attention to audit reports and communication in investor presentation or asset analyst briefings, especially regarding key areas like asset impairment and revenue recognition and provisions as highlighted in the report 11.4. Number 4 is audit quality as a continuous process. Users should be aware that a lot of judgment is needed throughout an audit. 6 emphasize areas which highlight ongoing improvements in audit quality, suggest that users should evaluate whether the financial reports are improving every year based on these findings. In conclusion, audit information users thoroughly assess, review, and understand the limitations of the audit processes to confidently use and rely on the financial and other information when making decisions based on the audited reports. Now coming to question number 5, this is the advice where we have to give to the practicing auditors based on the above findings. According to Suleiman 2013, in the modern businesses, it is necessary to audit the company due to the separation between ownership and control where shareholders entrust managers with resources to maximize wealth. However, managers may not always accurately report the company's performance, causing losses for the owners. Therefore, auditors play a crucial role in reducing agency costs. Based on the inspection report 774 findings, the following are key recommendations for practicing auditors. Firstly, is clarifying the scope of audits. Auditors must make sure that users understand the inherent limitations of the audit process. Audits can reasonably assure that there are no major misstatements in the financial accounts, but they cannot ensure that all fraud or errors will be found. Therefore, auditors should proactively communicate this scope to clients, management, and other stakeholders. Number 2 is concentrating on high-risk areas. Asset impairment and revenue recognition are two areas where ASIC has identified recurrent issues. While auditing these high-risk areas, auditors need to make sure they follow strong audit processes and must critically evaluate the management assumptions, especially in cases involving subjectivity and judgment, as these can lead to material misstatement. Auditors must apply professional skepticism to evaluate the reasonableness of key assumptions, particularly in areas with high estimation uncertainty. Now, number 3 is effective communication. Auditors should engage in open and continuous dialogue with directors, management, and audit committees, particularly in areas where significant management is required. It will be easier to maintain alignment and guarantee that users of financial statements comprehend the audit's conclusions if audit findings risks, and concerns about major misstatements are communicated in a clear and proactive manner. The ASIC's report has emphasized the need for auditors to critically evaluate areas such as asset impairment and revenue recognition. So, however, some auditors may cite challenges or cost constraints as reasons for not fully addressing these high-risk areas. So this should never come at an expense of audit quality. To make sure audits are carried out in compliance with the auditing standards, audit firms should invest in staff training and routinely review their audit techniques. Next is maintaining auditor independence. Integrity is the foundation of high-quality audits, so auditors must avoid any conflicts of interest that could compromise their objectivity. Practicing auditors should ensure they maintain professional skepticism and remain free from influence by clients or other stakeholders that could impair their judgment. Lastly, ASIC's surveillance findings underline the importance of complying with all relevant auditing standards. By adhering strictly to professional standards, auditors can provide high-quality audits that meet regularity expectations and reduce the risks of enforcement actions. In conclusion, by focusing on these areas, auditors can help improve the overall quality of financial reporting and better fulfillment their role as key gatekeepers in the financial system. So these are the references. Thank you.